Welcome back. I'm John A.G. All right, today is not a comfort show. This is a pressure show. Silver is sitting in the low 70s, the chart is starting to lean over, the oil market is screaming again, and the same people who were cheering every green candle 2 weeks ago are now asking one question. Is this a breakdown, or is this the setup? Before we get into the levels, one quick thing. My own YouTube stats show a lot of you watch these videos regularly, but still have not subscribed. So support the work, hit subscribe, and drop any real comment below, even if it is just John AG, because that tells the algorithm this content has value. Now, let's get to the market. Silver has not collapsed, but it has lost momentum. That distinction matters. A collapse is panic. A loss of momentum is the market telling you that buyers are no longer in full control. After the failed push above the 50-day moving average, the move started to look less like a clean breakout and more like a bull trap. And once silver slipped back into the prior range, the technical crowd did exactly what technical traders do. They stopped asking about solar panels, China imports, debt, and currency debasement. They asked where the next support is. That is how this market works in the short run. It is not always logical, it is not always fundamental, it is not always fair. If silver were trading only on physical demand, the conversation would be very different. But silver is trading through futures, algorithms, headlines, margin, liquidity expectations, and fear. So when oil spikes, the first reaction is not always buy inflation hedges. Sometimes the first reaction is the Fed cannot cut, rates stay higher, the dollar gets bid, and metals get hit. That may sound backward, but that is exactly why this market keeps confusing people. Right now, the important level is not a prediction. It is a zone. Silver futures were around the low 70s after a sharp pullback, and some technical desks are watching the high 60s first, then the 200-day moving average area near the low 60s, if selling accelerates. Could that happen? Yes. Is it guaranteed? No. And that is where viewers get trapped. They hear a downside target and treat it like a promise. Markets do not make promises. Markets offer probabilities, then punish the people who confuse probability with certainty. So let's be very clear. A move toward 61 or even a deeper test toward 50 would not automatically destroy the long-term silver case. It would damage short-term sentiment. It would scare late buyers. It would probably shake out leveraged traders. But the bigger question is still this. Did the reasons for owning silver disappear, or did the price simply move against overcrowded paper longs? That is the difference between a broken thesis and a broken trade. And the long-term thesis has not gone away. China's silver appetite is still one of the strongest pieces of evidence in this entire story. March imports were reported near 836 tons, a record surge driven by investor buying and solar demand. That does not mean silver goes up every day. It means physical demand is still present underneath the noise. And if one side of the world is paying up for metal while the Western paper price is breaking down, that is not something you ignore. You study it. Now, the second driver is oil. West Texas Intermediate has been back above $100 while Hormuz disruption keeps supply fear alive. This matters because oil is not just another commodity. Oil is transportation. Oil is fertilizer. Oil is shipping. Oil is inflation psychology. When oil rises hard, it gets into everything. It changes the Fed conversation. It changes consumer confidence. It changes margins for miners. It changes food prices. And it changes the political pressure on governments almost overnight. So yes, oil can pressure silver in the short term if traders interpret it as a higher for longer interest rate problem. But the same oil shock can also strengthen the long-term metals case if it pushes the system toward more deficits, more emergency liquidity, and more currency debasement. This is why the same headline can be bearish today and bullish 6 months from now. The timing is the dangerous part. Now let's talk about the UAE, because this is not a small headline. The United Arab Emirates is leaving OPEC effective May 1st, after nearly 6 decades inside the group. Reports differ on whether it is the third or fourth largest producer in OPEC, but either way, it is a major producer, not a footnote. The reason being discussed is simple enough. Abu Dhabi wants more freedom to monetize expanded capacity, while OPEC quotas have limited output. That is the clean version. The more complicated version is the geopolitical version. The UAE wants strategic flexibility. OPEC wants discipline. Saudi Arabia wants cohesion. The market wants barrels. And the United States wants energy stability without another inflation shock. That does not prove any secret deal. It does not prove swap line conditions. It does not prove a petrodollar reset tomorrow morning. But it does tell you the old oil structure is under strain. And when oil structure is under strain, inflation structure is under strain. And when inflation structure is under strain, silver investors should be paying attention. There has also been talk about dollar liquidity, swap lines, and whether emergency facilities could become another form of global easing. Let's separate the fact from the fog. A dollar swap line is a liquidity tool. It gives foreign central banks access to dollar funding when stress builds. That is not the same thing as classic QE, where the central bank buys assets in size. But in a crisis, the market may still read it as liquidity support. And markets often trade on liquidity before they trade on definitions. That brings us to the Fed balance sheet. Total Fed assets were listed around $6.707 trillion for April 22. That is not the 2020 panic expansion, and it is not the 2022 peak, but it is still enormous. The point is not that every uptick equals a new money printing cycle. The point is that the system remains dependent on backstops. Debt is too large, markets are too fragile, and policymakers have very little tolerance for disorderly liquidation. That is the macro silver argument, not silver must rise tomorrow. The argument is that the paper system keeps needing rescue. Former Treasury Secretary Henry Paulson has warned that the U.S. should have an emergency plan ready in case Treasury demand breaks down. Jamie Dimon has warned that debt, oil, geopolitics, and private credit could create more stress than investors expect. Now, you do not need to agree with every warning. But when people who spent their careers inside the system are talking about bond stress, credit stress, and contingency plans, you should at least ask why. And this is where the precious metal story becomes bigger than a chart. Silver can break a moving average. Gold can retest support. Miners can get hit. That can all happen while the long-term monetary story is actually getting stronger. In fact, late-stage bull markets often do this. They punish overconfidence, reset positioning, and then move again when the crowd has become exhausted. That does not mean you chase blindly. It means you stop treating every red candle as the end of the world. Now, let's talk miners, because this is where pain gets amplified. When silver falls 3%, miners can fall 5, 7, or more. That is not a conspiracy by itself. It is leverage. Miners are businesses. They have input costs, energy costs, labor costs, political risk, and financing risk. If oil is rising and metals are falling, margins get squeezed from both sides. That is why miners can look terrible even when the long-term metal thesis looks attractive. The metal is one trade. The miner is another trade. Do not confuse them. There is also a difference between owning physical metal and trading paper exposure. Physical silver has no margin call. It does not send you an email demanding more collateral. It just sits there. Paper silver, miners, options, and leveraged products can move fast enough to force decisions at the worst possible moment. That is why position sizing matters. Being bullish is not a strategy. Surviving volatility is the strategy. And for anyone watching who has actually done well in this market, share your experience in the comments. Not to brag, but to help people understand what patience, sizing, and discipline really look like. A strong community is not built only by people shouting targets. It is built when people show what worked, what failed, and what they learned. And just to be clear, this is not financial advice. This is market analysis, risk analysis, and a framework for thinking through a very messy environment. You have to decide your own sizing, your own cash position, and your own tolerance for volatility before you touch any trade. Now, here is the food angle, and this is where the conversation gets uncomfortable. Oil pressure is not just an energy story. Fertilizer prices are being pushed higher because energy is a major input. Wheat has surged to the highest level since 2024 as drought and fertilizer costs hit supply expectations. The World Bank has warned that energy and fertilizer pressure from the Middle East conflict can feed directly into inflation and hurt developing economies. This is not abstract. This is grocery bills, bread prices, farm decisions, and political pressure. And no, this does not mean panic. It does not mean run around like the world ends tomorrow. But it does mean food security is not a joke. If you stack metal because you do not trust paper promises, then you should at least understand that food is the most basic form of real-world security. Silver protects purchasing power. Food protects time. You need both ideas in your head, even if your personal strategy is different. The U.S. drought issue matters because crops do not care about narratives. If moisture is not there, yield risk rises. If fertilizer is expensive, farmers may adjust planting decisions. If energy stays expensive, transport costs rise. And if all of that happens while household budgets are already tight, the political mood can change fast. This is where markets become social. People can ignore gold. People can ignore silver. They cannot ignore food. So what does this mean for silver? It means the market is caught between two forces. On one side, short-term technical pressure is real. The failed breakout matters. The 50-day moving average matters. The risk of a deeper test matters. On the other side, the macro backdrop is not calming down. China demand is strong. Shanghai premiums remain important. Oil is unstable. Fed liquidity questions are back. Treasury market risk is no longer fringe. Food inflation is becoming harder to dismiss. That is not a simple environment. That is a dangerous environment. And dangerous markets do not move in straight lines. They rally too far, break too hard, frustrate both sides, and then make the next move when the crowd is emotionally exhausted. So if you are a trader, you need levels. If you are a stacker, you need discipline. If you are an investor, you need a time horizon. And if you are new, you need humility more than you need a price target. Could silver fall first? Absolutely. Could a peace headline hit tomorrow, oil ease, rate cut expectations return, and silver rip higher before buyers get their perfect entry? Also yes. That is why waiting for the exact bottom is usually a fantasy. The better question is not, where is the bottom? The better question is, what amount can I buy without losing sleep if price drops again? Because this is the part nobody likes to say out loud. Most people do not lose because silver moves against them. They lose because they build a position too big, too fast, with no plan. Then the market gives them a normal correction, and emotionally it feels like disaster. That is not investing. That is stress management with a ticker symbol. So here is my view. The short-term chart is damaged. I am not going to pretend otherwise. A drop into lower support would not surprise me. But the long-term case for hard assets is still alive because the debt problem is alive, the energy problem is alive, and the global liquidity problem is alive. If anything, the system is showing us again that every crisis eventually becomes a liquidity conversation. And watch the key signals. Watch whether silver holds the low 70s or loses that area. Watch the high 60s. Watch the 200-day region. Watch oil above 100. Watch any real reopening around Hormuz. Watch whether UAE barrels can actually reach the market or whether disruption keeps supply trapped. Watch China's import numbers. Watch Shanghai premiums. Watch the Fed balance sheet. Watch Treasury auctions. Watch food and fertilizer prices. Not because one data point decides everything, but because the pattern tells you whether stress is fading or spreading. The mistake is to turn every headline into prophecy. A chart breakdown is not the end. A record import number is not an automatic moonshot. A Fed balance sheet uptick is not always QE. A swap line is not automatically a secret reset. But together, these things show pressure. And pressure is what eventually forces repricing. So, no, I am not calling this a silver disaster. I am calling it a test of the chart, a test of conviction, a test of whether buyers are serious or just emotional. If silver drops toward the 200-day moving average, the comments will turn negative. The same people begging for a dip may suddenly be afraid to buy it. That is normal. That is how bottoms often feel. They do not feel comfortable. They feel wrong. But if silver stabilizes, rebuilds, and starts reclaiming lost levels, then this failed breakdown could become one more shakeout in a much larger bull market. That is the cliffhanger right now. Are we seeing the start of a deeper correction, or is this the final cleanout before the next leg? Drop your view below. Are you waiting for 61? Are you buying slowly here? Or are you holding cash for a bigger flush? And if you have had success stacking, trading, or simply staying patient through this volatility, share it with the community because people need real examples, not just noise. I'm John A.G. Stay sharp, stay disciplined, and do not let one red day make your decisions for you. Subscribe before you leave because the next few sessions in silver, oil, and food inflation may tell us whether this is only a chart pullback or the beginning of a much bigger reset.